Good morning and a warm welcome to all the participants, my dear students, supporting staff at ASAR. Let me introduce myself. I am Dr. Anthony Joseph from Department of Commerce, St. Berkman's College, 𝐂𝐨𝐬𝐭. I had been in the field of teaching for the last 28 years, and for the last 25 years, I am teaching at St. Berkman's College. I am so happy to share my experience and knowledge with you. Today we are dealing with the topic, a reconciliation of cost and financial accounts belonging to the fifth module of Advanced Cost Accounting. Okay, so we are going to start with the dictionary meaning of the term reconcile. From reconcile, we have reconciliation, the term reconciliation. So the term reconcile, Webster's dictionary says the term reconciliation is bring into harmony or to settle. So when do we need to settle or bring something into harmony with another? When there are two things, when there are two people, when there are two opinions, we need to bring them into harmony. When there is a difference between the two things, when two people are speaking about the same thing, there may be differences of opinion. The same thing may be spoken, but there may be some differences between the two people. So, if you want to reconcile or if you want to bring them into harmony, we want to reconcile. So, the dictionary meaning of the term reconcile is to bring into harmony or to settle the difference. So, we are moving to another thing. In cost accounting, what we are trying to reconcile? We are trying to reconcile the profits disclosed by cost accounts with that of the financial accounts. The profits, we are trying to reconcile the profits disclosed by the cost accounting department or cost accounting cost books with that of the financial accounts. You know that, PG students always know that cost accounts as well as financial accounts of an organization record the same transactions, same thing. That means recording, cost accounting as well as financial accounting are recording the same revenue, same cost, same expenses of the organization. Same thing is recorded, but the result, that is the profit, differs. That is the question. The profits disclosed by cost accounts and financial accounts differ even when these two sets of accounting are recording the same thing. The difference may be due to a number of reasons. And hence, to ensure the accuracy of both the systems, we want to ensure when both the systems of accounting are recording same thing and the results are different, we want to ensure the reliability, the accuracy, and the dependability of both the systems of accounting. So now we have the first question to you students. Why we need reconciliation between profits as per cost accounts with that of the financial accounts? Why we need reconciliation between profits as per cost accounts and financial accounts? That is the first question. You students, please remember, this may be a short question for you in your final examination. Think about it. Why we need reconciliation between the profits as per the cost accounts and the financial accounts? There may be a number of reasons, but the whole reasons can be clubbed into two. The need for a reconciliation arises only because of, the first reason is the profits disclosed by cost accounts and financial accounts differ. If there is no possibility for a difference between profits as per cost accounts and the financial accounts, there is no need for reconciliation. And the second is profits are reconciled to ensure the reliability or accuracy of the cost and financial accounting systems. We want to ensure whether the profits disclosed by both the systems are true. We agree that there are possibilities for differences in the profits. That is true. We are also agreeing. Even then we are checking, we are reconciling whether the differences arises only because of the possible differences or because of some other errors. So you students always remember these 2 points. Why we need a reconciliation between cost and financial accounts. The first reason is profits disclosed by cost accounts and financial accounts differ. That is a fundamental reason. And another is profits are reconciled to ensure the reliability, accuracy, or dependability of both the systems of accounting. There may be some other reasons, but these are the very, very important reasons for conducting reconciliation. Reconciliation may be done to enable the organization to have an internal check in the system. That can be another reason to ensure a good internal check system in the organization is also a reason. Students, I think you are clear. This is a very, very important question, fundamental question. Another area is why profits as per financial accounts differ from profits as per cost accounts. The same question can be raised in another way. That is, what are the causes for the difference in the profits as per financial accounts and cost accounts? So these 2 questions give the same answer, why the profits of financial accounts and cost accounts differ. Students always note down, from theoretical point of view, this is a very important question. This can be a 5 marks question. Okay, there are different reasons for disagreement between the 2 systems. One reason can be under or over absorption of overheads. Or from a layman's point of view, it can be the difference in charging of overheads. You know that the cost accounting system has its own principles, its own method of recording transactions. Financial accounting system has its own method of recording transactions. The financial accountants are expected to follow the accounting standards, accounting concepts, accounting principles. So the method of recording transactions in cost and financial accounts differ, so that there are possibilities for under absorption of overheads or over absorption of overheads in the cost accounting department, the cost accounting books. Remember, when we speak about under or over absorption, that refers to cost accounting only. Absorption is applicable only for cost accounting. Remember, absorption is applicable only for cost accounting. Let us classify the expenses into 2 different categories. We have learned that expenses of a business organization can be classified into 2 different categories based that is direct expenses and indirect expenses. Direct expenses and indirect expenses. Indirect expenses are technically known as overheads for cost accounting purposes. So for indirect expense, we will use only the term overheads. Look at the row representing direct expenses. In financial as well as cost accounts, direct expenses are recorded on actual basis. What does it mean? On actual basis means, think about financial accounts. A financial accountant, before entering a transaction into his journal, that is the primary books of account, the entry is based on what? It is based on voucher. Voucher is the evidence for the transaction. That means, in financial accounts, direct expenses are recorded on actual basis or the actual expenses, the expenses actually incurred are recorded in financial accounts. Similar is the case of cost accounts also in respect of direct expenses. In cost accounts also, direct expenses are recorded on actual basis. The actually incurred direct expenses like direct materials, direct labor, and other direct expenses are recorded in both financial and cost accounts. But there is a difference in respect of overheads. In respect of overheads also, in financial accounts, it is recorded on actual basis. That means the actual expenses are recorded, actual overheads are recorded, actual indirect expenses are recorded in the financial books. Whereas, what happens in cost accounting? Overheads are, the actual overheads are not considered, they are not directly recorded, overheads absorbed based on a predetermined standard are recorded in cost books. You have studied about overhead. We are estimating how much should be the overhead to be incurred for producing a particular unit of output. So there is a difference here in the treatment of or in the recording of overheads. There is a difference in financial accounts. Actual overheads are or the indirect expenses are recorded, whereas in cost accounts, absorbed overheads are recorded. So let us see what's happening here. As far as direct expenses are concerned, whether this will create some changes or a different disagreement between the two. As far as expenses are concerned, financial and cost accounts, there is no chance of disagreement. It will be recorded. For example, if the direct material cost recorded in financial account is 2,50,000, the same 2,50,000 will be recorded in cost accounts also. So there is no chances of disagreement between cost and financial accounts as far as direct expenses are concerned in almost all cases. As far as overheads are concerned, there is a chance for disagreement between cost and financial accounts. You know now, there is a chance. In one case, we have absorbed overhead, and in another case, we have actual overheads. There may be some difference between the actual and absorbed. Cost accountants usually try their level best to make the absorbed overhead equivalent to actual expenses, but this is practically not always possible every now and then. So there will be some differences between the profits disclosed by cost and financial accounts due to the absorption of overhead in cost accounts. Okay, I think this point is clear. So even then we have to discuss more about this. I have two cases. We are now going to discuss the first case, case A. Actual factory overheads incurred by a company as per the financial books is 40,76,000. It is 40,76,000. The cost accounting department absorb factory overheads on the basis of machine hour rate basis. We have studied machine hour rate. Am I right? Listen, machine hour rate is the indirect expenses to be incurred for running a machine for 1 hour. The cost of running a machine per hour is technically known as machine hour rate. This machine hour rate is actually a standardized one. It is prepared it is calculated in advance without considering the actual expenses for the current period. So our standard machine hour rate for our company is rupees 1000 per hour. Rupees 1000. That means to operate the machine in our company, we need to spend 1000 per hour. And the total machine hours operated during the period is given as 4500. Machine hours operated is 4500 and the machine hour rate is 1000 per hour. So look at the factory overheads absorbed in cost accounts. Factory overheads absorbed in cost accounts will be 4500 hours multiplied by machine hour rate, that is 1000. That is 4500 into 1000, that is 45 lakhs is the factory overhead absorbed. That means we are recording rupees 45 lakhs as factory overheads in our cost books. Clear? We are recording rupees 45 lakhs as the factory overheads in our cost books. But in the financial books, we can record only the actual. The actual is how much? 40 lakh 76,000. 40 lakh 76,000. By comparing the overheads as per cost books and that in financial books, you can see a difference. A difference of how much? A difference of 4,24,000. There is a difference between cost accounts and financial accounts as regards factory overheads for rupees 4,24,000. Then look, factory overheads in cost accounts is more than that in financial accounts. We consider it as factory overhead over-absorption. So over-absorption of factory overhead happens. Over-absorption of overhead happens when over-absorption arises when the overheads absorbed in cost accounts is more than the actual overhead recorded in financial books. You must be very, very clear. Okay. Over-absorption means overheads as per the cost accounts is more than that in the financial books. Clear? Over-absorption arises when overhead absorbed in cost accounts are more than that the actual overhead recorded in financial books. When cost books records higher amount for overheads, we call it as over-absorption. Okay, students, listen. Then what will be the under-absorption? When cost books shows a lower amount of overhead than that is recorded in financial books, the shortfall is technically known as under-absorption of overhead. Okay? When cost books is absorbing less, means cost books is recording lower amount of overheads than that in financial books, the result is under-absorption of overhead. Okay, clear? Under-absorption and over-absorption should be very clear. This can definitely create difference in the profits disclosed by financial accounts and cost accounts. Okay, let us see another case, case B. Students, you are required to record this figure, that is factory overheads over-absorbed as per case A is 4,24,000. You take down it. Over-absorption as per case A is 4,24,000. We need it later. Okay, coming to case B. The actual factory overheads incurred by the company as per the financial books is 45,90,000. 45,90,000. This is another case. Actual expense is 45,90,000. As in earlier case, cost accounting department absorb factory overheads on machine hour rate basis. And the standard machine hour rate is 1000 per hour. For this company also, standard machine hour rate is 1000 per hour. You please don't believe that there is say similar machine hour rate for all companies. This is only an imaginary case. Here, the standard machine hour rate set by the company is rupees 1000 per hour. Students, do you know exactly how this machine hour rate is actually computed? Really computed. This is based on past data. Okay, the machine hours operated by this company is 4,400 hours. Machine hours operated is 4,400 hours and machine hour rate is rupees 1000 per hour. So that how much will be the factory overhead absorbed in cost accounts? How much will be the factory overheads absorbed in cost accounts? Factory overheads absorbed in cost accounts is 4,400 into 1,000. That is 44 lakhs. 44 lakhs is the factory overheads absorbed or factory overheads recorded in the costing books of accounts. But in financial books, we can record only the actual. It is 45,90,000. So there arises a problem of under absorption. Now the company has under absorbed factory overheads to the extent of rupees 1,90,000. Okay, 1,90,000 is the difference between 45,90,000 in financial books and 44 lakhs in cost accounts. Cost accounts has charged less by rupees 1,90,000 in its books. This is under absorption. So what is under absorption, or when will under absorption arise? Under absorption arises when the expenses or the overheads absorbed in cost accounts is lower than that the amount recorded in financial books. Okay, here under absorption is 1,90,000. This figure is also important. 1,90,000. You take it down. Okay. Now we have to think about the impact of under or over absorption of overheads on profits disclosed by cost accounts. We have raised the first cause of disagreement as under or over absorption of overhead. Remember, the first reason for the disagreement between the cost and financial accounts may be due to under absorption or over absorption. So we have to learn exactly how the under absorption and over absorption are impacting the profit. Okay, as for case A, the over absorption was rupees 4,24,000. Over absorption was 4,24,000. Remember, you have noted down. The general accounting logic, we have also some logic in recording transactions. General accounting logic says that when we charge more and more expenses, the resulting profit will be less. Okay? When we are charging more expenses, when we are charging or when we are debiting more and more expenses in the trading or profit and loss account, the resulting profit will be less. Remember this. Over absorption means what? We are charging more expense. Where? In cost accounts. We are charging more expenses in cost accounts. So naturally, the profits disclosed by the cost account will be less. Okay, remember, try to understand this logic. When there is over absorption, we are charging more expenses in cost accounts. As a result, the profits disclosed by the cost accounting books of accounts will be lower. Okay. Now take the case of our case A. Over absorption 4,24,000. How it is impacting the profit of the company disclosed by cost accounts. How it is going to impact the profit disclosed by the cost accounting of the company. Now you know that we have charged overheads more by rupees 4,24,000 than in financial books. So what happens to the profit disclosed by the cost accounting? The profit disclosed by cost accounts will be less than that disclosed by the financial books by rupees 4,24,000. The profit disclosed by, when that over absorption, the profit disclosed by the cost accounts will be less than that of that disclosed by the financial books. Here it is, the amount is 4,24,000. The difference between the profits, that is between cost accounts and the financial accounts will be, the difference will be 4,24,000. That we are to reconcile. Okay. You take down this point. Over absorption of overhead in cost accounts will result in a reduced profit in cost account. Over absorption of overhead in cost accounts will result in a reduced profit in cost account. Or, in other words, now we were actually thinking from the point of view of cost accounts. We can also think from the point of view of financial accounts also. Okay. Due to over absorption in cost accounts, the profits disclosed by financial accounts will be comparatively higher than that in cost accounts. Don't be confused. Due to over absorption in cost accounts, the profits disclosed by the financial accounts will be comparatively higher. When comparing the profits between cost accounts and financial accounts, the profit of the cost account will be higher. That means profit of the cost account will be less. Okay, remember? Okay, clear it? Hope you know it now well. If you have some queries, please note it down. Now moving on to the impact of under absorption on the profit disclosed by cost accounts. Under absorption means what? The amount charged in cost accounts or the expense charged in cost accounts is lower than that recorded in financial books. Okay. Now take the general accounting logic again. In yellow, you look at it. Lower the expense charge, more will be the profit. That means when there is under absorption in cost books of accounts, the expense charge is lower. The expense charge is less. So naturally what happens? The profits disclosed by the cost accounts will be more. When there is under absorption, profit disclosed by the cost accounts will be more. Okay. So take the case of our case B. How much was the under absorption? I think it was 1,90,000. Am I right? If it was 1,90,000, if under absorption was 1,90,000 or any other figure, profit will be more in cost accounts by that amount. That is, if under absorption is 1,90,000, profit in cost accounts will be more by 1,90,000 than that in financial accounts. Okay, you always remember this. Keep it in permanent memory. In case of under absorption, profits as per cost account will be more than that in financial account. Profit in cost account will be more than that in financial accounts. Okay. Now we are moving on to the second aspect. That is reason number 2. The first reason, remember, under or over absorption. While answering the question for the examination, you are to write the theoretical part and the illustration so that you will be able to score 100%. Okay, case 2. Different basis of valuation of inventory. There is a possibility for differences in the valuation, the basis of valuation of inventory in financial accounts and cost accounts. There is a possibility. So before going into that, what are inventories? You know exactly what are inventories. The stock of raw materials, then work in progress, finished goods, and so on. These are inventories, the stock in trade. Now the question is there any difference in the method of inventories in cost accounts and financial accounts? In order to understand that, we have to make it sure or make it clear the method of valuing inventories in cost accounting as well as in financial accounting. In cost accounts, inventories are always valued at cost price. Remember, in cost accounting, inventories are valued at cost price. But in financial accounts, inventories are valued according to the principles of accounting standards. It says that inventories are to be valued at cost or market price, whichever is lower. Okay? Inventories are to be valued at cost price or market price, whichever is lower. And another problem now creeps up. What's it? What is this cost price? What is this cost price? The cost may be the weighted average price or price determined under FIFO method or LIFO method and so on. So remember, there is definitely or there may be a difference in the basis of valuing inventories. When there is difference in the basis of valuing inventory, definitely there will be difference in value of inventories put into the trading account or to the manufacturer. Okay. When there is a change in the basis of valuing inventories, differences between the figures of the same valued under cost accounting system and financial accounting system. That will create a difference between the profits as per the accounts and cost accounts. And now we have to look at the impact of difference in the valuation of inventories. About inventory is include opening and closing stock. Okay, opening and closing stock. If there is a difference in the value of inventory, that means there are differences in the value of inventory at the opening, at the point of beginning the accounting year and at the point of ending the accounting. The closing, opening as well as closing stocks will differ in terms of value in cost accounts and financial accounts. Okay, the general general logic regarding the value of stock. When other items in trading account or manufacturing account remain constant, more the value of opening stock in one set of accounts than the other, the profit will be less. Carefully listen. More the value of opening stock in one set of accounts, the profit will be less in that set of books. Opening stock more means we are putting more amount on the debit side of the trading account. When there is more on the debit side of a trading account, the gross profit will be less. And the net profit also will be less. That is the logic. More the value of opening stock, the profit will be less. On the other hand, more the value of closing stock. Closing stock is credited to the profit and loss account conventionally, not in the case of companies. In case of companies, while preparing the profit and loss account, we are taking only the difference in the value between opening and closing stock. But from conventional point of view, more the value of closing stock in one set of account, the profit will be more there. The same organization recording the value of closing stock as per its cost accounts and financial accounts differ. Suppose if the value of closing stock in cost account is rupees 50 lakh and that in financial books it is 49 lakh, then the profit in cost account will be more because the closing stock is recorded as a higher amount in cost books. Higher amount means the difference between 49 lakh and 50 lakh, that is 1 lakh. 1 lakh more credit is available in the books in the financial books. So the profit will be more by rupees 1 lakh. Okay. So once again, remember, we are thinking from the point of view of cost accounts, or generally, higher the value of closing stock will create higher profit. Higher the value of opening stock will reduce the profit, and vice versa. Okay. Point number 2 or reason number 2 is difference in the basis of valuing inventories. Okay. Difference in the basis of valuing inventories. The third reason, the difference in the methods of charging depreciation. Difference in the methods of charging depreciation. You know exactly what is depreciation. Technically, it is simply, or from a layman's point of view, depreciation is a charge for the use of assets, fixed assets. There may be some difference in the methods of computing depreciation on fixed assets under cost accounts and financial accounts. There may be some differences in the method of computing depreciation under the two sets of accounts. This is not compulsory, but usually it happens. You know that in financial accounts, we follow the regulations regarding the Companies Act and the Income Tax Act for the computation of depreciation. We have to follow the accounting standards. We have to follow the Companies Act. We have to follow the Income Tax Act for determining the method of charging depreciation on fixed assets in financial books. But in cost accounts, there is no such regulation. Cost accountants are charging depreciation on the basis of actual usage or estimated usage, or maybe calculated on some technical basis. In cost accounts, depreciation is calculated on the actual usage of the asset, or it may be calculated based on some techniques. there may be some differences in the amount of depreciation charged by the cost accountants as well as the finance. So naturally, it will create differences in the profit. Now we are coming to very important, very item. Cost number 4 or reason number 4 is items of pure financial nature included in financial accounts. Items are or some transactions are recorded only in financial books of accounts. And these can be classified into 3 different categories. Pure financial items, the financial books of accounts only, that is recorded in the cost books of accounts. These are classified into 3 categories, that is financial receipts, that is the revenue in financial nature only, the amount received by the business organization in financial nature. There are some financial charges or expenses which are recorded in financial books of accounts only. And there are some cases of appropriation of profit also. These are the 3 different financial items which are recorded in financial books of accounts alone. So we have to see some examples for that. Pure financial receipts. Usually, these pure financial items are credited to the P&L account in financial books of accounts. Pure financial receipts are credited to financial accounts, credited to the P&L account in financial books of accounts. They are not at all recorded in costing books of accounts. What is the effect? When there is credit in financial account only, that is credit in the P&L account as per financial only, the profit disclosed by the financial account will be more. Profit disclosed by the financial account will be more. That means profit recorded or profit reported in the cost accounting cost accounts will be less. Okay? When there are some financial revenues or receipts which are recorded in the financial P&L account, which are not at all recorded in the costing books of accounts, result in higher profit in financial accounts or lower profit in cost accounts. Okay, let us see some items. These are very important. These items are very important because in questions, these items may paper. The pure financial receipts recorded in financial accounts alone may interest or dividend income on investments. Interest or dividend income on investments. This is not at all recorded in costing books of accounts. Then transfer fees of shares. This is a nominal amount collected by the company for facilitating the transfer of shares by one person to another. Usually nominal amount, but credited to the profit and loss account. Then maybe brokerage received or on capital transactions. Profit on sale of some assets. If the company has sold some assets, and if there is some profit, normally it is to be that is the financial accounting principle. But on the other hand, sometimes if it is a nominal amount, it may be credited to P&L account. If profit on sale of any kind of asset credited to P&L account, that becomes a pure financial receipt. Then rent received by us by subletting or profit on sale of stores, equipments, etc. Sometimes there may be the organization might have sold some of its stores or equipments. There is any profit that also is not recorded in cost accounts, recorded only in financial books. Note down all these: interest or dividend income on investment, transfer fees of shares, brokerage received on capital transactions, profit on sale of assets, rent received on subletting, profit on sale of stores, equipments, etc. These are pure financial receipts credited to the P&L books, but not recorded in the cost books. So naturally, the profit as per the financial books will be more than that in cost accounts. Okay, are you clear about it? Then another is financial charges. Like pure financial receipts, we have pure financial charges. That means pure financial expenses. Some expenses are pure financial in nature, which are not recorded in cost accounts according to the cost accounting principles. Okay, what will be its effect? When some of expenses are debited in financial books of accounts only, some items are debited in financial books of accounts only. What will be its? Please remember, profit as per financial accounts will be less. Profit as per financial accounts will be less. That means profit as per cost. Comparatively, profit as per cost accounts will be more. Profit as per financial accounts will be less. The items are, you also note down these important items. Discount on issue of shares or debentures. Discount on issue of shares or debentures. Remember, discount on issue of shares or debentures may appear on the debit side of the P&L account. That is, the written off portion of the discount on issue of shares or debentures will appear on the debit side of the P&L account. That is what is here written as discount on issue of shares or debentures. Then loss on sale or exchange of assets. Sometimes some assets may be sold. Sometimes some assets may be exchanged. That may result in loss. And if it is debited to, it may be debited to the P&L account. There are other treatments also, but sometimes the loss may be debited to the P&L account. Then the profit in financial account will be less. Then regarding donations, charities, etc. These are not at all recorded in cost accounts, recorded only in financial books. Donations, charities, etc. Okay, then financial charges like bank charges and so on. Then maybe preliminary expenses are written off, underwriting charges paid off, fines, penalties, etc. Sometimes goodwill may be written off. These are pure financial charges. Pure financial charges. Remember, take down all these: discount on issue shares or debentures, loss on sale or exchange of assets, then donations, charities, etc. Financial charges, preliminary expenses written off, underwriting charges paid, then fines, penalties, etc. Then goodwill written off. Moving on to the next. Sometimes there may be appropriation of profit. Some appropriations of profits are recorded in financial accounts. When there are some appropriations of profit in financial accounts, the profit disclosed by the financial accounts will be less. Remember, appropriations of profit. Examples for appropriations of profit: transfer to reserve, proposed dividends, interim dividend, income tax or provision for income tax, and so on. These are not at all recorded in costing books of accounts. Always remember, these items are not at all recorded in costing books of accounts. These are usually debited to the profit and loss appropriation account. So the end result of the profit will be less in financial books. Okay. Take down all these: transfer reserves, proposed dividends, interim dividend, provision for tax. Okay, moving on to the next. Some items are, another item is, another cause for the change in the profit between cost and financial account is, some items are recorded in cost books only. Some items are recorded in cost books only. Examples are interest on capital, salary paid to the proprietor of a business, rent on own building. This may be directly charged to the costing books. These are not at all allowed to be recorded in the financial books. These are actually the opportunity cost or implicit cost. May be recorded in cost books. If such items are recorded in cost books, the profit disclosed by the cost books will be naturally less than that in financial books. Okay? Okay, today before winding, tell you that there are two different methods for reconciling the profits between profits of cost and the financial accounts. They are preparation of a reconciliation statement, then preparation of a memorandum reconciliation account. Preparation of a reconciliation statement and preparation of memorandum account. Okay, before concluding, I would like to why we need reconciliation. What are the reasons? The first reason for reconciliation is under or over absorption. Remember, under or over absorption. The second reason is the differences in the basis of valuation of inventory. Differences in the basis of valuation of inventory. And the third reason may be difference in the methods of charging depreciation. Okay? Difference in the methods of charging depreciation. And the fourth reason is there are some pure financial items which are recorded in financial accounts only. Such items are not recorded in cost accounts. These financial items are classified into financial receipts, financial charges or expenses, appropriation of profit. And another fifth reason is some items are recorded in cost books only. Cost books permits the recording of implicit cost like interest on capital, salary to the proprietor, rent on building. Such items may be recorded in cost books, create a difference in the profit as per cost and book and financial books. And lastly, one more reason may be there. While dealing with the process cost accounts or in the while learning the fundamentals of cost accounting, we have learned that there are provisions in the cost accounting books for recording the abnormal gain and abnormal loss. They are settled down in the cost accounting books. That may also result in that is another. The sixth one is the treatment of abnormal gain and abnormal loss in financial books of accounts. In cost book result in a difference between the profits disclosed by financial and the cost books of accounts. Okay, I hope you have learned something. This is only the beginning. In the next session, I will come up with the problems, different varieties of problems. We will solve it together. I will explain it again and again so that you will be able to understand much better. You always remember, you can have a 1-2 marks question from this side, 1 5 marks theoretical question maybe from this side, 1 5 mark problem question maybe from this side, and there may be some more big question from this side at the end of the sections.
We have 2 questions received. Sir, can you please answer those questions?
Definitely. Okay.
One question is regarding does all firms and business enterprise maintain both cost and financial accounts? If not so, is this reconciliation process applicable in any scenario? That is one question. And the other question is, sir, is there any item that shown only in cost accounts?
Okay, answering to the first question. Is it compulsory or is it essential to have cost accounting and financial accounting together in any business organization? All organizations are not compulsory to have cost accounts, depending upon the nature. Some business organizations are actually exempted from applying cost accounting. And even if cost accounting system is actually used in a particular organization, there are provisions for integrating the cost and financial accounts. When both these systems of accounts are integrated, actually there is no need for the reconciliation of profit between cost and financial accounts. But practically there are less chance for integrating all aspects of cost and financial books of accounts. Okay. That is the answer to my first question. The second question was regarding, is there any item recorded in cost accounts only? Coming to the current slide, there are some items, some implicit costs like interest on own capital, remuneration to the proprietor of the business, rent on own building. These are not actually recorded in financial books, but in cost accounting books, these may be recorded, not compulsory, may be recorded according to the cost accounting policies of such organization.
Data for cost accounting എവിടെ നിന്ന് ലഭിക്കുന്നു എന്നൊരു ക്വസ്റ്റ്യൻ വന്നിട്ടുണ്ട്.
Actually, always remember, cost accounting system, the records of the cost accounting systems are not actually requested to be published. This is actually for internal purpose. The financial accounting systems are actually publishable. They are to be published according to the statutes, but cost accounting systems are maintained by organizations for internal decision making, and if it is legal, in some industries it is compulsory to have cost accounts, and such data are to be given to the government agencies only. These are also not usually published. High profile research organizations may be able to access such data in the ordinary web or any ordinary publications. We will not be able to get the cost accounting details of any organization.
One more question has been asked. Does the item charged only in cost accounts reduce the profit or increase the profit in cost accounts?
When usually the items recorded in cost accounts represents almost all are expenses. Say for example, interest on own capital, salary to proprietor, rent on own building. These are actually the notional expenses which are debited to costing P&L account. Normally, the profit in cost account will be less. When more expenses are debited to costing P&L account, the profit disclosed by the costing P&L account will be less.
So I would like to thank you on behalf of us, sir, for taking today's session, sir.
I also would like to thank you guys all for supporting me. Thank you so much.
So I would like to thank all the participants also for attending.
Okay.
So it was a great session. Thank you all the participants for participating in today's session. Thank you and have a nice day.
Okay, sir. Okay, thank you.